Hi, I'm Rico O'Mara of O'Mara Trading. I'm a swing trader in the UK. I trade the UK and the US stock markets. I pull profits out of the market to pay my bills every week, every month, because I need the cash flow. I'm not an investor. I'm not a day trader. I have developed a strategy over time to find where I best fit in the market. I suffer from ADHD. I need to develop my strategy around that because I'm impulsive. I have trouble paying attention. So being a swing trader, researching markets, researching companies, and then planning where I'm going to execute my trade is perfect for me. It keeps me grounded. I keep to my rules. And that's what's needed when trading. We need to keep to his rules. I am a trend trader. I follow the crowd. I'm looking for strong companies in strong sectors, in strong markets. I want a company with a good product or service that's in high demand, with strong investor sentiment. Right now we're in earnings period, earnings season. And this is where we find out how some of the biggest companies in the US have done over the past quarter. Right now, there's a lot of emphasis on AI. That's where the crowd is. The crowd has been in tech for a long time, especially in the last few months in AI. But whereas before we were talking about bubbles, I think right now we're getting confirmation that this isn't a bubble because people are asking the questions. They're asking about the fundamentals. And these kind of things do not happen in bubbles. Every day I'm getting up and I'm researching companies. I'm looking at what companies have been reporting. I'm listening to what they're saying right now, especially around AI. As you can see by looking at some of the charts from the companies that have reported, it's not looking good. They're all pulling back because when these companies are priced to perfection, the crowd is looking for perfection from the earnings and they're just not getting it at the moment. I want to talk about AI, the profits, and why the market feels so uncomfortable right now because on the surface, something doesn't make sense. We keep on hearing on earnings calls from all the companies that have reported so far that AI is starting to turn into real revenue. In some cases, real profit. Companies are talking about margins, backlog, contracts, and customers who are actually paying money for the services. And yet, AI stocks have been choppy. Some have pulled back hard like Microsoft. Others can't seem to hold momentum that we need. And investors seem nervous, impatient, and frankly, a little bit fed up. So what's going on? To understand this, we need to stop looking at AI as one big trade and start breaking it down properly. And last night's Google earnings are actually a really good case study for where we are in this cycle at the moment. First, let's get one thing clear. This is no longer the AI's just hype phase. That phase, I think, is over. Across the market, we are now seeing AI monetize. In the software, companies are charging for AI features. In advertising, AI is improving targeting and conversion, just as we heard from Meta. In cloud, AI workloads are being paid for, often under multi-year contracts. So when people say AI isn't making money, I think that's wrong. The real problem now isn't whether AI is making money. The problem is where the money is showing up and who is spending the most to get there. Let's think about the AI market in three layers. At the bottom, you've got the applications, the software, the ads, the subscriptions, the productivity tools. I'm thinking Google, Palantir. This is where AI is closest to the customer. This is where we're starting to see clean profits. Then in the middle, you've got the platforms. Also Google, like with its cloud, and Microsoft's Azure and Amazon's AWS. They sell the picks and shovels to the companies that are building the AI products. Profits here are emerging, but they're uneven and capital intensive. At the top, you've got the infrastructure, your NVIDIA, your AMD, the data centers, the servers, GPUs, power, networking. This is where the biggest spending is happening. This is where investors are most uncomfortable. Right now, those big AI infrastructure players are effectively building 500 houses for 200 people. Not because the demand is fake, not because they don't know what they're doing, but because if they don't build now, they risk of running out of capacity later. Data centers take time. Supply chains take time. Power and land take time. So companies are building ahead of demand. That makes sense. Financially, it's painful, but it's completely normal. And markets hate that pain before rewards, which is why we're seeing so much choppy action right now. So what did Google say last night? Well, Alphabet, Google's earnings were actually quite a good, clear story about AI if you read past the headlines. On the positive side, AI profits are coming through from the bottom up. Google Cloud is a clear example. Google Cloud revenue was up 50% year on year, but more importantly, Google operating margins jumped to around 30%. That's not hype, that's profit. Management said that AI products, things like Gemini-based solutions, are now generating billions in quarterly revenue. This is AI paying its own way. That matters because it tells us AI demand isn't just experiments or demos anymore. It's workloads, it's contracts, it's customers spending real money, which is what the market wants to see. But is it enough? Also, from Google, search is a second piece. This is where a lot of people are still feeling a little bit uneasy. The fear is simple. If AI answers the question fully, then who's clicking the link to the adverts? That fear isn't going away. But Google's message is quite clear and consistent. They said AI is expansionary for search. People are searching more, not less. Queries are longer, sessions are more conversational, and crucially, commercial queries are still there. They said that AI helps monetize searches that were previously hard to monetize. Longer, more complex, more nuanced searches. So while we don't see an item in the earnings saying AI search revenue, the underlying engine still appears healthy. That doesn't mean there's no risk. It just means the worst case scenario isn't showing up in the numbers yet. There's also a quieter profit stream that often gets ignored. Looking at subscriptions, Google One, YouTube Premium, AI-enabled plans. These grow strongly and management tied some of that growth to AI features. Subscriptions are important because they monetize AI directly. No ad auction, no click-through debate, just people paying for better tools. That's another bottom-up signal that AI can make money. So if AI profits are showing up, why is the market still nervous? Because it's all about the cost. Alphabet has guided $175 billion to $185 billion for capital expenditure in 2026. That's a massive number. That is just like the same as what Meta and Microsoft have been telling us. It's doubling from previous years. Most of it is going into servers, data centers, and networking equipment. Management have been very honest about this, especially on the call last night. Depreciation will rise sharply. Data center operating costs are going to rise. Energy costs will rise. Even with all that spending, they still expect to be supply constrained. That's the key tension. AI is profitable at the application and platform level, but infrastructure is being built faster than utilization can immediately absorb. Again, 500 houses for 200 people. So again, this is why I don't think it feels like a bubble yet. In a bubble, demand is vague. Revenue is hypothetical. Customers are speculative. Here, customers are signing contracts. Backlogs are growing. Usage is real. The problem isn't fake demand. The problem is timing. The money is coming in layers, and the top layer is spending now for returns later. Markets struggle with this, especially markets and a crowd that is used to instant gratification. This is why I said it's not an easy AI trade anymore. Last year, you could buy anything that said AI in its earnings, and it was hard to lose money. All you had to do was just ride the momentum up. That phase is gone. We've made us money. Now it's time to put the work in. Now the market is asking harder questions. Where's the profits coming from? Who is spending the most? Who has pricing power? Who can absorb depreciation without killing margins? That's why this is a stock pickers market now. This is where we're going to put the work in. For swing traders like us, it matters because trends, they don't disappear. They pause, rotate, and reprice. AI hasn't ended. It's digesting. The crowd got a little bit of ahead of itself. Prices ran ahead of fundamentals. Now, fundamentals are slowly catching up. Price moves faster than earnings. So all we have to do is sit and wait patiently. So what are we waiting for, especially when this comes to companies like Google? Well, I'm waiting for confirmation that utilization is catching up with capacity. I'm waiting for cloud margins to hold while growth continues. I'm waiting to see if that AI monetization in search and ads is additive and not cannibalistic. I'm waiting for free cash flow to stabilize, even with heavy investment. When those pieces start lining up, sentiment will shift again. The crowd will notice. The crowd will create a new trend, a new boom to the upside. It's our job to sit and wait. Most traders make the mistake of forcing trades in this kind of market. They either chase every AI bounce or they give up completely on the theme. Both are wrong. This is the middle phase of a long trend. It's messy, it's frustrating, it's boring at times, but it's where the best swing traders get prepared, do the research and build watch lists. Listen, the takeaway is simple. AI is and will turn into profits. Google shows that clearly, especially from the bottom up. But infrastructure is being built faster than the market can emotionally tolerate. That creates volatility. It creates severe pullbacks. It creates opportunity later, but not immediately. As swing traders, our job isn't to predict the future. It's to wait for the crowd to all agree again and start producing higher highs and higher lows that we can jump on. I think these pullbacks is not a sell signal. It's a signal for us to just wait. Let those houses fill up. If you want to know more about what I'm looking at, what I'm researching, give me a like, give me a follow, and let's build a like-minded community of people who want to get involved, who want to support each other through the market. There's no bullshit here. There's just trading with honesty and transparency. I'm not here to sell you any strategies or give you any free signals. I've got no Lamborghinis. I've got no penthouses in Dubai to share with you. I've just got my research. There's always a trend and I want to build a community of people that want to go out and search for it.